Hi guys, it's Jared here from Beyond Accountancy. This is part 2 of our video about superannuation contributions, and it's for people earning under $50,000. We can't give you advice through this means. You're welcome to contact us to get advice about the tax implications of super. For broader superannuation advice, you'll need a financial planner. So who's this video for? It's for you if you're a low income earner, so earning under $37,000 or perhaps just above that. For example, a low or middle income earner up to about 50 grand. Or if you're a one income family and your partner is a low income earner and you're looking for some concessions for topping up your partner's super. So we're going to talk about 3 different contribution types and how they might apply in the different tax brackets. So there's concessional contributions. Concessional means deductible. These are contributions that you make to try and reduce your taxable income. Then there are non-concessional contributions. They don't reduce your income, but they can be used to get you a government co-contribution. And finally, spouse contributions, where the higher income spouse tops up the super of the lower income spouse. So 3 contributions types we'll be talking about and 3 tax brackets that we'll be talking about. So for starters, the lowest tax bracket, which is the $0 to $18,000 bracket, then the 21% bracket and the 34.5% bracket. But first, the tax-free threshold might be $18,200, but once you factor in low income offsets, you actually don't pay any tax till you make $21,884, which is important. So if your income's below this number, a concessional contribution, so one that reduces your income, is going to be of no benefit at all. Because if your tax bills are already nil, then deductions are pointless. You can, however, put $1,000 into your own super. If you meet the eligibility, the government will put $500, and your spouse can contribute up to $3,000 to your super and get 18% back as a tax offset. We'll go through the eligibility rules later. Just being in this bracket isn't enough to necessarily get you those different concessions. Let's do an example for somebody in the lowest bracket. So Ben has an income of $85,000. Eva has an income of $20,000. Eva could contribute $1,000 non-concessional to get the $500 co-contribution. Concessional contributions would be pointless, and Ben could put $3,000 to get $540 back on his tax return. So that's where contribution types would work in the lowest bracket. So what about the next bracket? Well, first, let's adjust that lower threshold to $21,000. In this bracket, there is some benefit of concessional contributions by reducing your income down, but only if your income doesn't end up below the threshold, the $21,000, and if your total super contributions between you and your employer are under 3,333, I'll explain why in a minute. You can still get the co-contribution in this bracket, and you can still do the spouse contribution in this bracket. So why am I saying there's only limited benefit in reducing your income? Aren't deductions a good thing? Well, the reason is, if you look in that third column there, the difference between the tax on concessional super and the personal tax rate in that bracket is only 6%. So you're locking away money in super, you're only gaining 6% for it. Not really worth your trouble. That doesn't mean you shouldn't make contributions at all on that bracket. There's actually a $500 benefit for people putting money into super who earn under $37,000. Effectively, it means there's a tax-free threshold for super. So the first $3,333 of concessional contributions that you get as a low-income earner, basically tax-free. But the limit includes employer contributions. So I'll do a couple of examples that makes this a bit clearer. Say we've got Phil, he works part-time, makes $24,000. He works for an employer, so he gets his 9.5% super. So that's $2,280. So Phil could actually make a concessional contribution up to the 3333, so that's $1,053. That would work for him. And he could also put in another $1,000 to get the co-contribution, because just that first 1,000 alone, because he's deducting it, it means it's no longer eligible for the co-contribution, so he'd need to do both. And that would save him some tax and get him the $500. Compare that to Georgia, who's a sole trader earning a similar income, but because she's a sole trader, she has no employer who's topping up her super, so that she's got the whole 3333 tax-free threshold for her super to work with. So she could benefit from $4,333 of total super, split into those two amounts that you can read on the screen there. And finally, the third bracket. So you might have a lower income, but it might tip over the $37,000 mark. So what does that mean for you in that bracket? Well, there's a benefit of concessional contributions. You actually save 19.5% tax for whatever you put into super in that bracket. You can still get a co-contribution. You get the full co-contribution if your income's below 38,564. That's income before deductions and with some add backs, which I'll cover in a minute. And you get a part co-contribution up to 53,564. But you won't get a spouse rebate. The spouse rebate starts to phase out between 37 and 40,000, and above 40,000, you won't get anything at all for it. So why is there a 19.5% saving when you contribute to super in that bracket? Because the difference again between the personal tax rate and the superannuation tax rate. So let's say we've got Michael who earned $45,000 for the 2020 financial year, and he wants to reduce his taxable income by topping up super. There'd be a tax benefit for him to put $8,000 into super, because that reduces his income down to $37,000, so he's saving that 19.5%. But any more than $8,000 would push him down into that next bracket, where he's only saving 6%, so that would be negligible benefit. So you want to try, and if you're just into that third bracket, there's going to be a tax benefit in getting yourself down to 37 grand, but not much further than that. So hopefully that gives you a good overview of the different contributions. I want to run through some of the details of who's eligible and who's not, because it's not as simple as just saying if you're in that bracket and you put the money in, you'll get the benefit. There are some other criteria. So start with spouse contributions. So how does it work? You can get a tax break if you have a low income spouse. You get 18% back on what you put in, and the maximum is $3,000 with a rebate of $540. It's a good way to build your retirement savings, especially for couples who like to combine their finances and work together. So essentially the higher income spouse puts super into the money of the lower income spouse, fills out some paperwork. That's important. The fund will ask you to fill out spouse contribution paperwork in most cases, and then you can claim the rebate on the tax return of the higher income spouse. It's the only example of a tax break for topping up someone else's super. So one of the things to be careful about is what income means. It's not your taxable income, it's your assessable income before deductions. And you add back reportable fringe benefits, so for your salary packaging, and reportable employer contributions, so if you're doing salary sacrifice. So be careful if you have a low income spouse who works for a hospital or a charity and does salary packaging, as this could mean you're not eligible for the rebate. Let's take two contrasting scenarios, one eligible, one not. So Brad is a scientist earning $120,000. His wife Claire is a part-time vet with an income of $35,000. Brad puts his $3,000 in, he can claim $540 in his tax return. That's our basic case. A bit more complex for Luke and Jenny. Luke is an engineer. His wife Jenny is a nurse. Her income is $35,000, but she also has reportable fringe benefits of $17,000 because she can salary package as a nurse in a public hospital. So her total income is $52,000. That's well above the $37,000 limit, for the rebate, even for the part rebate at 40,000. So Luke will get nothing. So be careful if there's salary packaging going on, because you might put money in super, it's locked away, and you've got nothing for it. And finally, you actually can have two partners who are both eligible. So Dennis and Dawn both work part-time with income of $35,000. Even though neither is a higher earner, they could both put $3,000 to each other's super and both get the rebate. It's quite a tax-effective way of doing it. And lastly, on spouse contributions, yes, there's a benefit in doing this, but actually if you're the higher earning spouse on a high bracket, you actually make more by topping up your own super in some brackets. So it's 18% benefit for spouse contribution, but you can see there are two brackets there where you save more topping up your own super. Other criteria, you can't claim a deduction for the contributions. The person has to be your spouse when the contribution's made. You can't be separated. You both have to be Australian residents, and your spouse can't have gone over their contributions cap. So what about co-contributions? So what is it? It's a scheme for low-income workers and business owners. So you have to be working or earning income from business above a certain limit. The government will match 50 cents in the dollar for personal super up to $1,000, so the maximum government contribution is $500. 10% or more of your income has to come from work or business. So if you're primarily living off savings or share portfolio or rental properties, this isn't going to work for you. You get the full entitlement under 38,000 and a part entitlement up to 53,000, and you can't be a temporary resident other than Kiwis who have special treatment. There's also an age limit. You need to lodge a tax return, and you can't have gone over your super limit. So pretty much you just put the money into super, lodge a tax return, and you get the money. No paperwork, no fuss. As long as the money goes in and the return is lodged, the ATO will work out your eligibility and you get paid automatically. Pretty simple. It's worth noting if you're choosing between doing a co-contribution and a spouse contribution, just note that the co-contribution gives you a lot better return on your money, although you can't do as much. So I'll just finish with a couple of quick examples. So again, Brad and Claire, from our previous example, Claire's income is $35,000, so she can put $1,000 into her super, and she gets $500. Contrast that with somebody who's not eligible. So Jim is a retired school teacher, does a bit of exam supervision, but he largely lives off his investments. He puts his $1,000 into super hoping to get the co-contribution. However, his work income is under 10% of his total income, so he doesn't meet the work test and can't get the co-contribution. Just a little warning, if you're only partly eligible, you don't need to put the full $1,000 in to get your entitlement. You just need to double the amount you're entitled to. So again, let's go back to Jenny from our previous example. So Jenny's income is $52,000 if you count the fringe benefits. Her co-contribution entitlement is only $52. She's above the lower threshold, but she's below the upper threshold. So for her to get her $52, she'd only need to put in $104. She would need to put in the full $1,000. So here are a couple of examples of different income levels and how much you can get and how much you would need to contribute to get that amount. And finally, deductible contributions. We talked about these, so I'll skip through this pretty quickly. There's a limit of $25,000 per year, including your employee contributions, but you're unlikely to use that limit on lower tax brackets. If you're in a higher tax bracket, we've got a separate video for that. If you do, however, choose to make a concessional contribution, just make sure that you claim the deduction by filling out the notice of intent to claim a tax deduction form, which again we talked about in our other video. If you need assistance with this, we're here to help. We can help with tax advice and tax planning. We can't do financial planning, but we can work with your existing financial planner, or if you don't have one, we can recommend one for you. With the end of the year approaching, you need to act fast if you want to get a tax advice appointment soon, or if you want to implement this yourself, you need to act fast to work out how late you can put money into super and meet your fund's cut-off date which could be as early as, say, the 22nd of June. We also now offer mortgage advice and refinance options for our mortgage broking partnership, if that's of interest to you. To get in touch, go to www.beyondaccountancy.com.au. For now, thanks for watching, and we'll talk to you soon.